Your credit score is the gatekeeper to cheaper loans and real wealth, not a trivia score you forget after you apply. Today, I'm calling out the credit mistakes that quietly burn dollars from your pocket, and I'll give you one practical plan to fix them. First, let's ground this in simple reality. A score isn't a personality test. It's a signal about risk. It looks at payment history, how much you owe, how long you've borrowed, new credit, and the mix of accounts you manage. Mess up one or two of those areas, and the numbers start ticking against you. Do a few deliberate things well, and the door to better deals slowly opens. Most people get stuck because they treat credit like a minor annoyance instead of a financial tool. They miss errors on reports, chase new cards, or let small habits pile up into big problems. None of that is mysterious once you see the pattern. What follows is a plan you can actually run, not a lecture you'll forget. Mistake number 1 is believing your credit report is perfectly accurate by default. In truth, errors sneak in all the time. Wrong addresses, outdated balances, closed accounts that still show as open. Those little mistakes can drag your score down and cost you months of better interest. The fix is straightforward, but it requires action. 2. Thinking utilization is the only thing that matters. Your total balance relative to your total limit matters, but not in isolation. If you carry big balances on a few cards and ignore other accounts, you're signaling risk. If you pay early and often, you signal discipline. The score doesn't lie, but it does read context. 3. Assuming your payment date is the same as your due date. That's a setup for late payments that ding your history and your score. A single late payment can stay on your report for 7 years, even if you correct your behavior tomorrow. Small, consistent actions beat heroic, last-minute efforts. 4. Chasing new credit without a plan. Every hard inquiry can shave a few points off your score and isn't worth it unless you genuinely need it. New accounts also reset the age of your credit, which temporarily lowers your average age and can affect your score. 5. Letting old accounts sit forever. The length of your credit history accounts for a big slice of the score. The oldest account matters because it shows stability. If you close your first card, the average age drops and your score can dip even if you aren't using it. Now for the good news. There is a single, concrete strategy that ties all of this to money in your pocket and to smarter investing too. A 30-day credit score sprint that creates durable habits and lowers borrowing costs in the near term, so you have more cash to invest or save. Here's the plan, chunk by chunk, with practical steps you can actually take. Week 1. Audit and fix fast errors. Start with a copy of your credit reports from all 3 bureaus. You can pull them for free once a year at annualcreditreport.com. Look for incorrect names, addresses, accounts that aren't yours, and late payments that you've already fixed. If you find mistakes, file disputes online and keep a log of every reference number you get. Make it a rule to check each report again in 2 weeks. At the same time, write down every account you see. Cross off the ones you've paid off or closed. If you see a balance you don't recognize, call the creditor. If you find an account that's not yours, file a fraud alert or freeze the file as needed. The goal this week is clarity, not drama. You're cleaning the room so you can move furniture later. Week 2, cut the signal noise on utilization. Your total credit utilization should be as low as possible, ideally under 10% and never above 30% for a healthy score. A simple tactic is to pay down balances before the statement closes, not just by the due date. If you can, set up 2 payments a month on big cards, mid-month and end, so the reported balance stays low. If your card limits are large but you carry a small balance, you may still be signaling risk due to how the balance reports. You can request a credit limit increase, but only if you're sure you won't be enticed to spend more. If you can't lower the balance quickly, consider moving some debt to a card with a 0 balance or a lower rate while you work it down. Another trick: ask lenders for a credit limit increase instead of opening a new card. A higher limit lowers utilization without increasing your exposure to new debt. If you must apply for new credit, do it sparingly and with a very clear plan for repayment. Week 3, lock in on-time payment discipline. Automate your payments so you never miss a due date, even during busy weeks. If you have multiple cards, set automatic minimum payments on all of them and schedule reminders for the bigger monthly payments. The goal isn't to push to the limit, but to maintain spotless payment history. Consider setting a calendar rule. Every time you get paid, you review due dates for the next 30 days and verify you have enough cash to cover them. If you're at risk of missing a payment, set up a temporary transfer from savings to curious cash flow to cover it. A small, consistent habit beats heroic last-second moves that could still miss a payment. Week 4. Reframe your approach to new credit. If you're considering a loan or a new card, ask, does this move reduce my cost of debt in the next 12 months? If the answer is no, don't apply. If the answer is yes, choose a clear, limited-purpose loan or card that you'll use to pay down existing high-interest debt, not to accumulate more. Also this week, give old accounts a gentle beat. Don't close them unless there's a real reason, annual fee, fraud risk, or you simply won't use them. The length of your credit history helps your score, and in many cases, the old account contributes to a stronger score than multiple new accounts could. Now, the midway result. By the end of week 4, you should have a cleaner report, lower reported balances, and a track record of punctual payments. That combination is what the score needs to move higher steadily. But the real payoff isn't just the number, it's what you can do with that number. Here's how a higher score helps your money plan and your investing decisions. First, cheaper money. A higher score often translates to lower interest rates on mortgages, car loans, and personal loans. If you're thinking about buying a home or refinancing, even a couple of percentage points drop in rate can save tens of thousands over a 15 or 30-year loan. The math is simple. Lower rate equals lower monthly payment and more money that can be invested or saved each year. Second, better insurance and banking terms. Some lenders factor your score into vehicle insurance premiums or offer better terms on secured lines of credit. The improvement can be small, but in a year it adds up. Your goal is to reduce the cost of money on the things you must borrow, freeing cash to invest instead of paying extra interest. Third, improved investment flexibility. A higher score can lead to more favorable terms when you want a margin loan against investments or fewer restrictions on borrowing against assets you already own. With lower borrowing costs, you can choose to invest more aggressively in opportunities you understand, or to hold more liquidity for opportunities that arise. Let's keep the focus on actionable money habits you can implement right now to reinforce this plan. Habit 1. Monthly credit hygiene check-ins. Spend 10 minutes at the end of every month reviewing your reports, looking for new inquiries, new balances, or any changes. This isn't about chasing perfection. It's about catching mistakes or changes before they become real hits to your score. Habit 2. A debt paydown calendar. If you're carrying balances, plot a payoff path that reduces high-interest debt first, then tackles everything else. The snowball method has emotional power, but the avalanche method saves more money in interest. Pick the method that matches your personality so you actually stick with it. Habit 3. Intentional cash flow management. A simple rule helps. Every dollar you earn should have a clear job. A portion goes to essentials, a portion to debt payoff or savings, and the rest to investing or education. When you tie your credit health to a clear cash plan, you'll see both your score and your net wealth rise in tandem. Habit 4. The missing link to investing, emergency fund and debt discipline. You cannot responsibly invest if you're one urgent bill away from debt. Build a small emergency fund first, then direct any extra savings toward both reducing high-interest debt and growing your investments. The discipline you gain with credit recovery becomes your investing discipline. Now, a caveat. Life happens, and sometimes a negative item on your report isn't your fault. If you have legitimate debts in collections or charge-offs, don't pretend they don't exist. Negotiate honestly with creditors where possible, ask for a payment plan, and, if allowed, request a goodwill adjustment for on-time history before the issue. Get it in writing so you have a record of any agreed changes. Progress may be slow, but even modest improvements compound over time. Let's talk about a smoother path that avoids the cringe and keeps the focus on real results. This isn't about hacking a score. It's about building a sustainable financial rhythm that supports smarter decisions in money and in the market. With a healthier credit profile, you're less hostage to high-cost debt and more free to invest or save with intention. If you're listening and you want one more practical nudge, try this simple setup: a weekly 15-minute money review. In that window, you check your spending, verify your balances, review upcoming due dates, and update your plan for the next week. It's small, predictable work, but it compounds into a much stronger financial position over months. To recap the core idea in one line: fix the small, repeatable errors, automate the dependable habits, and use a stronger credit score to lower costs and keep more cash available for investing. The payoff isn't a bigger number on a screen. It's a smaller debt burden, lower interest payments, and more room to build wealth. If you found this approach useful, stick with it and share your progress. The best success stories aren't dramatic. They're consistent decisions made quietly over time. You can begin today with one small step and keep going. Thanks for watching. If you enjoyed this, hit like and subscribe so you don't miss future clarity on money moves. Comment below with one credit mistake you're going to fix this month and tell me what topic you want next.